You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Gold, crude oil, corn, soybeans, and more. With so many tradable products, the futures options market can be an intimidating place. How can you possibly keep track of the latest trading developments across so many different products? Don't worry, we've got you covered. Welcome to This Week in Futures Options, the program designed to help active futures options traders stay on top of this ever-changing marketplace. Each week, we'll break down the top trades, hot products, volatility explosions, and much more. This Week in Futures Options streams live, so be sure to check out our live stream via the Mixlr app. That's MIXLR. Or join our live chat room at mixlr.com/options-insider. Whether you're an experienced veteran or a newcomer looking to separate the wheat from the lean hogs, This Week in Futures Options has the information you can't find anywhere else. This Week in Futures Options is brought to you by CME Group, the world's leading and most diverse futures and options exchange. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. This Week in Futures Options is also brought to you by FTSE Russell, a leading global provider of benchmarks, analytics, and data solutions. For more information, please visit ftserussell.com, cboe.com, and cmegroup.com. And now, get ready to break down the latest futures options trading activity. It's time for This Week in Futures Options.
All right, everybody. That music means it is Thursday. It is 1:30 p.m. Central, 2:30 p.m. Eastern. It is time once again for TWIFO, This Week in Futures Options. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the ever-exciting Options Insider Radio Network. So much stuff for you guys to check out over there. Of course, cmegroup.com/TWIFO or /TWIO is the place for you guys to go to get those great free reports on all things futures, options. If you want the great earnings analysis and all the other data, theoptionsinsider.com. Click on the Options News and Articles tab. And then, of course, if you want to go above and beyond with all the on-demand stuff and you want to go join us live as well as catch some of the exclusive shows, theoptionsinsider.com/pro. So whatever you feel like doing out there, we got something for you. And, of course, however you listen, live after the fact, keep hitting us up. Questions, comments, insights, pearls of wisdom. We do love to hear from all of you folks out there. Let's see who we're hearing from today, doing double duty once again, holding down the CME Group and FTSE Russell hot seat. Our old friend, Mr. Dan GRAMZA, the president over there at GRAMZA Capital Management, and man who's made one or two cool YouTube videos in his day. Mr. Dan, welcome back to the program, sir.
A lot to talk about, and you always do a great job laying things out for us.
I'm looking forward to it as well, Dan. So without further ado, let's dive into it. Let's kick it off the way we always do. It is time for the Movers and Shakers Report.
It's time to find out what's rallying on the light side and falling to the dark side at CME Group this week. It's time for the Movers and Shakers Report.
All right, everybody, welcome to the Movers and Shakers, the portion of the show where we kick things off, tell you what's moving and shaking to the light side, a.k.a. the upside, and to the dark side. Mr. Dan, You're our guest. You get pride of place, sir. Where should we begin our journey this week? To the light side or to the dark side, sir?
I'd say let's go to the dark side.
I think we can handle that. Let's go to the dark side, sir. Again, you can find this report. CME Group always tweets it out right before showtime, so you can follow them if you're not doing so already. Of course, if you follow us, we tend to retweet it. So those are the two places you can get it if you're not a premium subscriber to the Quick Strike tool. So this is a report reserved exclusively for the premium folks out there, but we share it with you because we like you. All right, let's get on out now, see what's lighting it up. And again, this week, kind of an equal week. Not a lot of movement really in either direction. They're both kind of, it's pretty much 50-50, and they're kind of shrugging your shoulders, except for the top and bottom movers on each one. They're moving. Everything else is kind of just like, what's going on out there? So let's go. I think Dan chose the dark side. So let's go out there. Number 5, WTI. Not surprised. I don't think any of you were probably surprised to hear energy is on our list this week. WTI off 3.3%. A lot going on out there in the world of energy this week. Number 4, copper off 4.66%. Number 3, platinum. So staying in the metals there, 5.54%. Number 2, going out to the virtual quote-unquote metal. Is it digital gold? What do you think? It's Bitcoin off 9.83%. It was number 1 in the other direction last week, up 6.54%. So hot and heavy couple of weeks for Bitcoin. It's now back below 60,000 as we're kicking off the show here, somewhere around 58,000 right, heading into showtime. And number 1 is the Eurodollar, as listeners taking a drubbing off 29.7%. That's a big move out there in Eurodollars. I'll dive into that a little bit later. And then back to the upside now, we go to oats, up 3.71% for number 5. Number 4, soybean meal, up 3.76%. Number 3, nat gas, kind of bucking the energy trend, saying, you know what, forget about what's going on with WTI. We got our own issues. Belarus, Eastern Europe, nat gas pipeline, demand going through the roof. Nat gas up 4.09%. It was number 1 in the other direction last week. Took a nice breather last week off 12.65%. Now gaining some of that back. Number 2, rough rice. It's been an interesting couple of weeks for rough rice. It's up 5.18% this week. It was number 4 in the same direction last week, up 4.29%. Again, don't get too excited. Right around 300 contracts on the tape out there. And then number 1 is our old friend, back to its old craziness out there. It's lumber, up 36.23%. It was number 3 in the other direction last week, off 4.16%. And again, talking about a dozen or so contracts on the tape. So not a big mover out there. But Dan, there's so many headlines. There's so much action. It's moving to the upside and to the dark side this week. I think we have to go to energy first.
It's time to tap into the deep options well of black gold, Texas tea, nat gas, and more. It's time to talk energy.
All right, everybody. Welcome to the energy section of the show. I got a feeling we're going to sink our teeth into a lot of stuff out here. A lot going on in the world of energy. Of course, you guys know where to find this, listeners. CMEgroup.com/TWIFO or /TWIO. And then from there, once you have the report up, listeners, go to that asset class scroll, go down a few slots to energy, then kick it on over. And depends where we start here. Should we start nat gas or crude oil? Dan, what's lighting up your tape? Should we start in nat gas or crude oil first, sir?
Well, I tell you what, let's start with crude.
All right, we can do that. A lot of headlines going on in the world of crude oil. By the way, listeners, the top of that product family drop down is crude oil. Go to that, then go to WTI. And you see in parentheses next to it, LO. That's where we're going to hang out there, listeners. And some action on the tape this week, 368,000 contracts on the tape as WTI trending back below the 80 handle, 78 and a third. These are levels we haven't seen in about 6 weeks out there. It's been hanging out north of 80 for a little bit. Of course, if you've been paying attention to the news out there, you know the Biden administration kind of on the warpath for high crude prices right now. They're pulling out all the stops. They're talking about opening up not just our reserves. They made the rather unprecedented move to go out to China, India, Japan, pretty much anybody who's not part of OPEC, and said, hey, maybe you guys want to tap into your reserves too. So they're looking at perhaps trying to flood the market with some crude, saying, yeah, OPEC, you don't want to raise your production? We'll see what we can do to match you out there. Of course, you need a lot of oil to hit the market to make really any sort of dent. They need at least 20 to 30 million barrels to start just impacting what's going on out there from a production standpoint out there. And that's not enough. That's not enough. He also sent a letter to the FTC this morning saying there is mounting evidence of anti-consumer behavior by oil and gas companies. He wants them to probe immediately into quote unquote unusual, I should say illegal activity. They use the word illegal activity that is occurring to drive up prices. He cited what he terms an unexplained large gap between the price of unfinished gasoline and the average prices for consumers at the pump as his evidence of potential wrongdoing. So, Dan, a lot of foot out here in the world of WTI. Administration's on the warpath. WTI finally retreating back below the 80 handle. You know, Dan, it doesn't seem like it was that long ago that they were paying you to buy barrels of crude, right? And everyone, as you recall, was wringing their hands. They're saying, oh my goodness, crude in the $30 to $40 a barrel range. That's so unhealthy for the economy. It's going to devastate companies. No one's going to be able to finance new wells. This is going to be horrible for the economy. And now here we are a year and change later, and it's the exact other side of the coin. Oh, crude is too high. It's going to be devastating for the economy. So what's going on out there, Dan? Set us straight.
Well, you know, it is an interesting market, and I really feel that the prices should be lower. Maybe we stay in a $10 range, $75 to $85 a barrel. And the reason I feel that way is there is supply out there. It's not like we don't have anything out there to use in terms of production, produced barrels that can be put into the global system. So personally, I don't think there's a global shortage. It's a matter of how much goes into our system. If you look at the U.S., you know, we're increasing our production. There's kind of near a max when it comes to shale in terms of wells available by drilling equipment, I mean. And labor is also at a shortage. Transportation is also a problem. But we are increasing our production in the States. And there's something else, I think, that we're seeing in the U.S. production. And some people feel it's at a plateau. I think there's more flexibility here. But the cost, the efficiency in the United States for a shale-produced barrel, let's say in 2014, that cost was $79 a barrel. In 2020, it was $47 a barrel. And right now they're saying with labor shortages and inflation, it's around $57 a barrel. In other words, that's the average cost it takes someone to produce that barrel. So when we're around $70 a barrel, it becomes attractive to start producing more crude oil. And I think that's part of what we're seeing going on now. There is an incentive to do it. And then some people are saying we shouldn't ship crude oil out. You know, during the Obama administration, the restrictions we had in this country were lifted. Then we send about 3 million barrels a day, last I saw, outside this country. And the other issue is that if we would try to change that, it could actually increase gasoline prices as it has an impact on the global supply in terms of how it moves around the world. So it's a very interesting market. And we're also seeing the efficiency in the Gulf. A Gulf-produced barrel of oil has also come down. So we're able to produce at cheaper prices. And you should also keep in mind, when it comes to crude oil, the cost for a shale-produced barrel is much less than it is for a Gulf-produced barrel in general. And also, there are companies now, because of efficiencies in technologies, our ability to not only drill horizontally, but to extend the distance that we drill horizontally. That also has made some efficiencies for companies. There are some companies that are efficient at $30 a barrel. They could still be profitable. So there's a lot of flexibility in here, and I just don't think we should see skyrocketing prices in crude oil. So we're in, I think, kind of the sweet spot for crude oil. A sideways move here through the rest of the year, I think kind of makes sense.
Wasn't that the big argument after the shock we saw to the system recently in crude oil? OPEC trying to shake out a lot of the U.S. shale producers who have a higher average cost to go. It's more expensive to go pull the oil out of shale than it is to pull it out of the ground in Saudi Arabia. So they thought they would game the system and take advantage of that higher cost and maybe squeeze out some of those producers by cutting prices. And they did. But the flip side of that is it also ended up making their surviving producers more efficient. So I heard the same thing you did, Dan, that a lot of producers now can produce in the mid $30 to $40 barrel range. So where we are right now should be just printing money for them.
Well, you're right. They're in good shape in that regard, depending on their debt load that they have. And you brought up another good point, Mark, in your intro to this section, and that is, what is the right number for energy? When energy prices are high, they say, look at the energy companies, look at those stocks. Those are the stocks you want to own because their revenue should go up. Excuse me. See, it chokes me up just thinking about this. Excuse me. But as those price per barrel goes up, then other people would say, well, hold on, the efficiency, the cost of energy is so high, it's going to affect the revenue stream of other companies because their cost is going up, and that means their profitability is going to go down. So there is this balance between what is the right number for crude oil companies, producers, to make money, but also not be too high that the cost of energy becomes a factor in other companies that use that energy to their profitability. So and who knows what the magic number is? Nobody really knows, but that is that give and take that we constantly see when it comes to this sector.
I think the moral of the story, Dan, is no one is happy no matter where crude prices are. When they're high, they're mad. When they're low, they're angry. When they're negative, they're certainly angry. So you can't win.
I think you're right, Mark. That's a good answer.
There's no happy price for crude oil is what I have discovered out there. Let's see what's lighting it up out there this week. In a pretty active week in WTI. I said nearly 400,000 contracts, about 370,000 contracts on the tape when we kicked off the show. And of that, it looks like 51.5%. So a significant percentage going up in the Jan contract that has about 27 days to go. Listeners, what's the vol out there right now? Things are pretty volatile, but the vol has actually come in a little bit since our last show, about a 32.64. That's off a little over 3 points from where it was this time last week. So some frame of reference, obviously more volatile than your standard equity out there right now, but less volatile than, let's say, a Bitcoin. Certainly less volatile, about a third of what's going on out there in nat gas right now. We'll get to that in a little bit. In terms of skew, this is where the options can potentially be telling us a tale. And right now, the tale hasn't changed much from last week to this week, which is interesting. Last week, they were telling us that the puts were bid. They saw that the administration was on the warpath and things might be trending to the south. The puts were 7.1% bid. This week, they're about the same. They're 7.3% bid. So that bid hasn't changed material. Now, you could say we've moved down the skew curve a little bit and they've actually ticked up. So that does show an even stronger increase to the puts. So you can look at it that way. But in general, skew is still roughly the same to what it was last week. Last week, the calls were 4.1% cheap. This week, a little bit cheaper, 6.2% cheap. So a little bit, but not a huge evolution on the call wing there as well. So puts still leading the dance last week and still leading the dance this week as well. In terms of what was the most active contract this week, was it a 90 call? Was it a 70 put? Are people buying calls, selling puts, buying puts? What are they doing out here? Let's find out. It looks like it was the 70 put. If you guessed Dark Side was the winner, you get the prize this week, listeners. 70 puts in January doing 17, almost 18,000 contracts. The busiest day was yesterday, 6,250 going up yesterday. Almost 6,000 on the tape today, though. So today is no slouch as well. 4,000 on Monday, only about 1,400 on Tuesday. Seems like it's been back and forth all week. It was opening on Monday, closing yesterday. We obviously don't know what today's paper was up to. So interesting stuff. Also, the fact that the put skew hasn't changed markedly, also perhaps showing us there is a lot of back and forth paper on the put wing. People are buying and selling puts, but net there is still a bid to these puts out there. Number two, though, it's not all puts all the time, listeners, because right behind it are the 85 calls, also in January, doing about 16,000 contracts. The big day Monday, actually, 5,100 on Monday, then a tie with yesterday and today, both days doing 4,200. Slightly opening on Monday, slightly closing yesterday. So again, kind of back and forth on the 85 call strike. So some folks betting on either a return to that upside level or perhaps fading it more by selling the upside. Either way, we saw a little bit of a downturn in the skew out there in the call, so maybe a little bit biased towards selling out there, but net still a lot of back and forth paper on the 85s. Also, we have the 75 puts going up in Jan, 15,000 of those this week for number 3. The most active day yesterday, 8,000, so more than half going up yesterday. Slightly biased towards opening. Again, it's kind of been a back and forth out here, which is interesting. I expected a little bit more directional bias in the paper out here this week. Total of about 15,000 almost on the tape. And you know what? That's not rich enough for your blood. If we go out to February of next year, we saw the 90 calls doing a fair amount of paper, doing almost 13,000 contracts on the tape. The big day actually today, over 6,000 going up. So pretty much half of that going up today. So 90 calls trading up a storm out here in February of next year. So that's interesting. I did not expect to see the 90s lighting it up out here as well. In fact, 90 calls were active across the board. They were active in February. They were active in March, about 7,000 in March, 90 calls in April, going up about 1,500 times. So it is not all puts all the time, listeners, if you go a little bit farther out in the term structure. Speaking of going farther out, let's look really quickly. Sometimes crude oil can be like gold. It has some nuggets lurking in the farther distant portion of the term structure. I don't see anything crazy out here unless you count a 4,000 lot of the 70 puts going up in June of next year as potentially crazy, and a 3 lot of the 100.5 calls. Other than that, not a lot of weird stuff afoot. Dan, what do you make of this options paper and the kind of surprising back and forth nature of what we're seeing? We're not seeing any market bias in one direction or the other this week, sir.
Well, I think it kind of makes sense, and I think the price action really shows us that. If we look at just the structure, we're trading between that $76, $77 range to $84, $83. And I think some of that action was being reflected in what you're talking about. And what was going through my mind as you were giving us those insights is when the puts are so much lower, you wonder if people are selling those puts to buy those calls to set that kind of structure up. I guess there's no real surprises, except it does say something about that Feb being out there at 90 on the call side, a bit the way it is. It's interesting about that volume. So what does it say about expectation? I think is one of the things that we can look at when we think about options. What are people anticipating? And the issue is, are they anticipating? Are they hedging? Is it part of a spread? We don't totally know that answer or those answers, but I find it interesting how people are positioning themselves as we go out in time. Excuse me, not too surprising, since there are a number of unknowns. What is our demand for crude oil? Not only for gasoline, but for jet fuel. If people start traveling, we're coming into that travel period. That's a possibility that can create some demand that prices can go up. I just don't think it's there, though. I still feel a sideways move here makes sense.
Well, the options seem to be backing that up, Dan. They're obviously they're still biased towards the puts, but perhaps not as directionally unanimous as you might expect coming into, and certainly all the headlines might lead you to think. And Dan, we can't get out of energy just yet because the other frequent offender bucking the trend to go into the upside is nat gas. This is one of those names that of late, ever since everything's just been popping off over there in Eastern Europe and has been trickling back here into the U.S. market, we've seen nat gas just on fire, extremely volatile. If I have to pick on any given week, a handful of names are usually somewhere in the number one spot, to the light side or to the dark side. Bitcoin's usually one you can guess with some certainty. Lumber was one for a while. It kind of fell off. Now it's back again. And then nat gas is another frequent offender. If you guess one of those three, you usually have a good chance of being right. That one of those is number one in one direction or the other that week. This week, nat gas actually number 3 to the upside out there, and a decent amount of action out there. Before we get into all the paper out here, by the way, listeners, you can stay in that same drop down. Just go out of crude oil, scroll one down the product family to nat gas. Pick the top one there. It says parentheses LN next to it, nat gas there. And that's where we're going to be off to the races. You will see a decently active week, 285,000 contracts on the tape. Dan, I know nat gas has been on your radar of late. A lot going off out there in the nat gas markets these days. What's been catching your eye out there?
Well, Mark, it surprises me. It isn't behaving. If you think about fundamentals, and then you think about where we are price-wise, they don't match up from the way I look at it. Fundamentals, demand, strong. If you mentioned what's happening in Europe, if we look at what they pay, what we paid $5 for, which is about where we are, Europe pays $24 to $25. Asia pays around $28 to $29. And if you're going to export nat gas, where do you send it? Which place can get the biggest bang for your buck? And we now have the ability to send nat gas out there, which we haven't had in the past. They take natural gas, that it's a gas, so that means the molecules bounce around and can float in the air, but we squeeze the heck out of it, make it very cold, and we can slow those molecules down to a liquid. And right now, we're near capacity in the United States to produce LNG, liquefied natural gas. And then where do we send it? And there's issues with the ships availability that we can move that product with. So there are some challenges here in the United States when it comes to our ability to export a lot more, but the demand is there. And if you think about also here, we use it in three major areas when it comes to natural gas. The northeast part of the United States does use heating oil, but for heating their homes and things like that. The rest of the states will use electricity, but primarily nat gas to heat our homes and cook our food. That's about a third. We also use about a third of natural gas in the steel industry and chemical industry, industrial sector that consumes a lot of natural gas in their processes. And then we also use another third basically to produce electricity. We produce in the United States more electricity with natural gas than we do with coal. And that changed a few years ago. So we have consumption here, and that's steady and strong. We have global demand that's far stronger than global supplies right now. If you look at Russia and that Nord Stream 2 pipeline going to Germany, which bypasses other countries. So far, though, Germany hasn't approved it. They haven't certified it. So nothing's running through it. And so there's two pipelines that are the Nord Stream 1 and then also the pipeline that goes through to the Ukraine. And we've seen Russia play the political game of we're going to shut the valve off kind of thing. But we want to remember who also is there, and that's our friends in Norway. Norway, when it comes to nat gas, they export almost all their natural gas. Their electricity, 92%, is done by hydroelectric. So they use water to produce their electricity, and the nat gas they send off to Europe. About 20% of the supply for Europe comes from Norway. And Germany now has import facilities for LNG, so we can send ships there and also offload. In the past, we haven't had that ability to offload there. Now we do, there and also in Poland. So it's an interesting market. It doesn't make sense to me, though, where we are. I would have thought by this time we'd be above $6.50 towards that $7 range. Remember, this is still moderate prices for this product. We've been at $12 before a while ago, but right now we're about mid of that range. So I think about value. This is mid value if you and I look back over time. And I think it's relatively cheap.
Yeah, you're right. I was surprised looking at the price levels coming into today's show. This $4.90 coming into today's show, listeners. It's up about 11 cents on the week, about almost 2.5%. If you extend it back to last week's show, the end of last week's show, it's actually up a little over 4%, but still $4.90. I thought, just given how much movement we've seen out there of late, that it would actually be higher. So you're right. Certainly compared to the rest of the world, it's a bargain. U.S. nat gas. Let's see what we've got out there from an overall action perspective. Like I said, almost 300,000 contracts on the tape. It's looking like an equity right now, listeners. 40% of that coming in the D's contract that is going away in about 6 days. So instead, let's go a little bit farther out the curve. There is some paper, about 15% in the Jan contract that has about 40 days to go. So we'll hang out there, 5 days to go and 6 days to go. With looking at skew and vol, it's kind of a strange measure. If you go out that far, if you go out about 30 odd days, we see that the vol, a little bit frothy, a little bit juicy. I said we're at a 490 on that front D's future. Get out to Jan, it's a 499. So a little bit richer, but not much. 95.5 is where the vol is out there, listeners, up about 4.25 points. Something to keep in mind as you're looking at our poll out there, our question of the week. We'll get to that a little bit later. In terms of skew, last week the puts were cheap, 11.3% cheap. This week they are even cheaper, nearly 17%, 16.9% cheap. Calls last week led the dance, 16.2% rich. So the bid, the concern, the fear, call it what you will, was all to the upside. This week, 14.8%. So that has come in a little bit, but still extremely bid to the upside. This is the inverse of a lot of your equity skews, right, listeners? Calls extremely bid, and nobody wants to touch the puts. Flip this with, let's say, the S&P or the Russell, and you'll see a very, very different story from a skew perspective. And in terms of the most active contract, if you said these 6 calls that are going out in about 6 days, you would be the winner chicken dinner this week, listeners. 13,500 of those going up. The big day was actually Tuesday with about 7,200. The rest kind of scattered throughout the week. Back and forth, opening and closing. No market bias in one direction or the other. Number 2, right behind it, were the 4 half puts. A little bit more reasonable strike out there, given the fact that we're at about 490 right now. Pretty far away from 6. The big day actually today for the 4 half puts. About 5,000 going up today, almost 3,000 on Monday, 2,000 on Wednesday, and 1,100 on Tuesday. And again, back and forth, opening and closing every day. So no real market bias in one direction or the other this week on the 4 half puts either. And then right behind that, we have the 4 quarter puts. Again, doing about 10,200 the big day Monday, 4,000 going up on Monday, 3,300 today, 2,500 yesterday, and just a few hundred on Tuesday. And once again, looks like actually Wednesday's paper was demonstrably closing. The rest of the week, there was no real opening or closing bias one way or the other. If we go out a little bit farther, though, we get to what Dan was talking about. We go out to March of next year. We see the 9 calls lighting it up this week to the tune of 9,500 contracts. Pretty much all of that today, Dan. 7,100 of the 9 calls have traded today. My goodness. Someone is on the warpath for these today. 7,100, 1,700 yesterday, and not much earlier in the week. Yesterday was actually closing. Of that 1,700, about half of it was closing. Obviously, we don't know what today's numbers are for OI change, but that's a lot of paper to go up in the 9 calls in March today. Interesting. So that gets back to what Dan was saying earlier. Maybe someone agrees with him, thinks it's a wee bit cheap. Let's look at the skew really quickly in March. Things get a little crazier. You go out to March, listeners. And the March did about 13%, 13.5% of the paper. So not a quiet month by any means. The puts in March, 15.2% cheap. This week, 24% cheap. My goodness, puts have gotten cheaper. The calls have actually come in. The calls last week were 25.9% rich last week. This week, 19.4%. So maybe they are selling some of those 9 calls. Not a huge move in the calls, but a decent move out there in the call wing. So interesting. Dan, 9 calls in March. Is that what you expected me to say when I started breaking these down, sir?
No, I was going to say it actually, I wouldn't have picked the 9 strike, but it does say something about beliefs. It does say something about attitudes. It does say something about how people may be positioning themselves in the future. And I think you're right. It does show us here that our prices here are cheap. And the expectation as our economy gets turned on and the global economy turns on, this is a product that gets consumed. And it's a product that we would expect that demand to continue to increase. It used to be that nat gas was a barometer for economic growth. A lot of people would look at that. And when it became very cheap, it became kind of disassociated with that. But I think it's back in that position. So if we think about our economy getting stronger or the global economy getting stronger as it gets turned on, watch natural gas. This could be that consumption pattern we're expecting to see, which indicates indeed the economy is getting stronger. So it's another reason why I think this is cheap where we are right now. And that 9 strike, I do find interesting.
Someone's got a big axe to grind out there, listeners. We're going to keep an eye on those March 9s. Those are interesting. Are they with Dan? Do they think it's cheap? Are they perhaps fading it? So, the skew might say to us, perhaps they are indeed fading it. But on the surface, if you looked at that, you would be forgiven for thinking they probably scooped it if you agree with what Dan's putting down out here. Meanwhile, though, we have to keep on rolling. There is vol across the board this week, including in the equities. So let's go find it.
It's time to explore the volatility swings, skew changes, and hot options trades in your favorite indices. It's time to talk equities.
All right, everybody. Welcome to the equities complex. You know where to find these. Now go to that drop down that was on nat gas, go into the asset class. Scroll down a couple from energy. You'll see equity indices. We're going to hang out in the U.S. Index E-mini product family, then scroll over to the product. We're going to kick things off in the Russell 2000 there, listeners, which is at about a 2360 coming into showtime, actually off. Nearly 50 handles or 2%. Small caps have been just crazy of late. A lot of people pointing the fingers, I should say, at the meme kids, the AMCs and the games, and others saying they're taking up a large share of the action out there in small caps. But whatever is driving it, there is certainly a lot of action afoot. Let's break it down. Before we get into that, let's get into what's going on from an overall vol perspective. Can't really talk equities without talking volatility, listeners. Two sides of the same coin. RVX, which is the VIX of the small caps, coming into showtime, is at about a 24 exactly. That puts it down about a third of a point. Not a huge net vol change week over week here in the equities, listeners. Vol is remaining stubbornly, some might say surprisingly firm. Others might say they expect that given what's going on there in the broad market, the concerns over the global economy, concerns over inflation, things going on with the Fed. A lot of things are combining to perhaps prop up the vol and keep it at some fairly frothy levels that some might say undervalued, others overvalued. Obviously, that's what makes a vol market. But intriguing stuff here. VIX coming into showtime is at about a 17 even. That's down a little over half a point, about 0.6 of a point from where it was this time last week. VVIX at about a 110. That's down nearly 2 points from where it was this time last week. Vol Q almost at an 18, about a 1790. That's down about exactly a point from where it was this time last week. Vol Q, of course, the at-the-money vol of the NASDAQ 100. So that puts that VIX to RVX, so the small cap to large cap vol spread at 7 points. It's getting wide. It's about a quarter of a point wider than it was last week, and certainly a lot wider than it was a few weeks ago where they were moving almost in lockstep. And VIX to vol Q, so the NASDAQ to S&P 500 vol spread at nearly a point, about 0.95. That's almost half a point wider. It got kind of crazily tight there last week, starting to widen out a little bit now, which makes a little bit more sense. You don't usually see those two vols so close together, but intriguing stuff nonetheless. Before I dive into all things small caps, Dan, what is lighting up your tape and the tape of your viewers over there, of your videos there, sir, on YouTube? What's been lighting up the tape in the world of equities?
Well, when it comes to the Russell, it's a puzzle. It really, I think the bias is still for a move to the upside. This indice can have a characteristic of leading the other indices. Now, at the beginning of the month, I thought we were going to see that. But it just lost steam as we hit that 2460. Sellers came in at that level, and we haven't seen it since. But I'm still looking for a turnaround in this market. My bias is for a move to the upside. One of the things I look at is what I call behavioral. I call behavioral Japanese candles, because we're not looking at patterns. We're really looking at the characteristics of how a market moves. Now, in the Russell, if we go back to it was just not that long ago. If you go back to November 3rd, that was a big up day. And if you look at the next few days after that to the 8th, from the 3rd to the 8th, what we did in those days, those 5 days, it's taken from the 8th till now to basically cover that range. My point here is what we did in 5 days has taken a lot longer to pull the market down. So in other words, have sellers come into this market the way buyers did? And I would say no, because it took more days to cover that same range we did in 5 days. So I still think price-wise, the bias is for a move to the upside. Today, it's a neutral position, and it could be a transitional position. In other words, sellers that were dominant are losing some of that dominance in today's action. And that's why it implies with the shadow on the top and the shadow on the bottom, it's the line that you see in the top and bottom of the candle, I think could imply a change in character. So, Mark, what's going to be interesting is how do people want to finish this week out? Do they want to go home short the Russell? I really don't think so. That's why I'm looking for an update on Friday. We want to see a closing above 23.90 for that market. So it's an interesting position that it's in right now, and I think it's got some upside potential. It's so different than what you and I see like in the NASDAQ or the S&P.
That is the case. That's what makes it fun to break down. And an interesting week this week. Usually when I get to the equities, it's a broken record. I don't care what it is. Small caps, NASDAQ, E-mini, S&P, whatever the heck you're looking at. All their action's going to be in the contract that has 1 day to go because that's how the equities play. This week, small caps bucking that trend a little bit. Almost 30%, 29.9% going up of that paper, this week's paper, going up in the D's contract that has nearly a month to go. That's amazing. I've never seen that before. Only 26.8% going up in the week 3 November contract that has a whopping 1 day to go. So we're going to head out to December. I love it. I love having a little bit more time to sink our teeth into out there. If you're wondering, coming into Showtime, small caps at a 23.60 off nearly 50 handles or 2.05%. Again, just huge swings, huge moves. We've seen the volume spiking across the board. We're seeing the volatility. We've seen a lot of action out here in small caps just in the last couple of weeks. We had our buddy Mr. Rhodes on the show a few weeks ago, and he was calling this aggressive Santa Claus rally in small caps, and that happened very quickly. And now we're kind of coming off the other side of that, it seems like, which is, again, interesting stuff. Let's go out now to the D's contract. The vol out there, about a 21.20, listeners, up about 0.75 of a point. So still frothy, still above, obviously, where VIX is, but not a huge premium there. In terms of skew, last week, the puts were 12.7% bid. This week, 12.8%. The calls last week, 8.6% cheap. This week, nearly 10% cheap, 9.7% cheap. Contrast that with what we were just talking about with nat gas, listeners, where it was pretty much completely the opposite. Huge bid to the calls, and nobody wanted to touch the puts. So that just shows market by market how the vol skews can swing. And in terms of, let's see, the most active contract out here, it was out in D's, and it was the 1880 put. I said coming into Showtime, we were at about a 23.60. So once again, it is this pretty far out of the money and not quite longer term. It's about a month. I guess for equities, that is long term these days. So everything's in the weeklies. So going out a month is pretty long term, but still a 1 month 1880 puts. That's, you're talking 500 handles almost out of the money. That's not exactly the strike most people would have assumed. But again, if you've been listening to this show for a while and looking at these reports, you'll know that it kind of is a regular trade out there in the Russell 2000. Someone likes to put these on, and now it looks like this week they were actually taking them off because most of that was closing. So they were closing out the 1880 puts. I'll have to look and see if perhaps they rolled them. And you know what? Looks like they did. They rolled the 1880 puts in December to the 18 half puts in January. So hence, that's why the puts longer term were lighting up the tape out here this week. So they're keeping roughly 18 half to 1880 put strike, keeping that alive for another month out there in the Russell 2000. So it's not all small calls all the time. It is also out of the money puts this week. Dan, keeping them alive, rolling the 1880 puts in Dees out to the 18.5 puts in January. Intriguing stuff. Anything else you want to hit on in the equities, or we got a little time left before we get to the listeners? Do you want to hit on another complex? If so, which one, sir? I'll let you choose. You're our guest.
Well, I'll tell you, as far as the equities go, the S&P, the NASDAQ is making new highs today. If we close at this range, it means the NASDAQ is on an uptrend. We don't have that with the other indices. And if you look at the S&P, my objective for that market, and I thought we would get near there by the end of this week. It'll be interesting to see if we do get follow through tomorrow, and that's at 47.20. I think that's the next important level. We don't want to just make new highs. We want to push beyond that. So we don't want to kiss 47.10. We want to close at least at 47.20 by the end of the week. That would imply buyers have returned and we're looking for movement to the upside. Would you want to talk about metals or currencies, or let's...
we got some metals moving and shaking this week, so we can head out there next if you like, sir.
Werewolves beware. It's time to explore the options activity in silver, gold, and other shiny things. It's time to talk metals.
All right, everybody. Welcome to the metals. We got a lot lighting it up on the metals front this week. Obviously, gold and silver get the lion's share of the headlines, but this week it was platinum at number 3, off 5.5%. Again, not a huge option stalwart. And then copper going out to the base metals, off 4.66%. So both of those dominating our dark side this week. Dan, you want to start with one of those, or you want to go out to the shiny stuff? I'll let you choose, sir.
Well, let's stay with copper. It's a market I am bullish on. I do look for further movement to the upside. But you know something, Mark? I've been saying that for a while, and it really hasn't cooperated, if I could say it, the way I pictured that market unfolding. We started to do that in October, getting near that 480 level. The supply, I think, is tightening a little bit, although there's been some release in Asia regarding copper. But I think that demand is there. It goes back to our economy. When we turn on the global economy as well as our own, that copper consumption goes up. And the issue is there enough supply to meet that demand? I kind of feel there's not. My expectation is for stronger prices in copper, especially as our economy does turn on. We use 400 to 600 pounds of copper in a new home. And what we saw yesterday was building permits increased. It says something about people willing and are ready to spend money. They're planning forward when we see those building permits go up like that. And one of the things that does have an impact on that is copper. That building permits, we use, again, 400 to 600 pounds of copper in a new home. We use 40 to 99 pounds of copper in a car, depending on the model. Electric cars use about 4 times that amount. We don't have a substitute for copper. That's what makes it so unique. We don't have another substitute that we can go to that has the characteristics of copper. So I am bullish on it. I do look for follow through. The big challenges to this market, it's actually about every 10 cents, I think. 440 to 450. If we get it close above 450, then the next objective would actually be 480 to 485. So it's a very interesting structure that we have, and I'm still on the bullish side when it comes to that complex.
So that means pretty much you're saying you're bullish China, Dan, right? You can't talk copper, I should say, without talking China. The two C's go hand in hand.
That's a very good point you're making, because China consumes about 48% of the global supply of copper. You're absolutely correct. If we look at demand for copper, we need to look at China. That's the number one consumer, then the United States, then our friends in Germany. Those are the 3 major consuming countries of copper. So yes, you are right on target. And yes, I do expect that China to get stronger in terms of manufacturing.
All right, let's check it out for ourselves and see what's going on out here. Listeners, again, go to that drop down and go to the metals. Go away from the precious this time, go to the base metals. You'll see copper at the top of that. Copper used to be a pretty quiet options product. Didn't really do more than maybe a couple of thousand contracts. That was on a good day. These days, doing more. Even on a light week like this, there's still 10,500 contracts on the tape, which again, it's not a Eurodollars. It's not a WTI. It's not an S&P 500, but it's still, for copper, that's a pretty strong growth trajectory. Coming into showtime, 431, off about 13.5 cents, or about a little over 3%. Of course, since our show last week, it's off nearly 5%, about 4.66% out there. So copper has been relaxing. Let's see what the options are up to. By the way, if you're wondering, vol out there, well, a third of the paper went up, 35%, I should say, 35.2% went up in the D's contract that has, looks like 5 days to go. So let's move a little farther out from that. Let's go out to Jan. That had about 19% of the paper out there. Actually, let's go a little farther. March seems like it was the next most active with about nearly 30% of the paper. And if you're wondering, by the way, the vol out here in copper, pretty rich. It's a 26 in that front D's contract that's going out in about 5 days. That's up about 3.25 points. If you go out to the March contract, which did about a third of the paper this week, that's about a 28.5. That's up about half a point. So copper vol is nothing to sneeze at these days, where a lot of other products are in the teens. In terms of skew out here in March, the puts last week, nearly 4% rich. This week, coming in, they're down to about 1.1% cheap. So they have swung in the other direction. And the calls, 1.5% cheap this week, about a third. So it looks like the skew is almost flat. The puts are a little cheap compared to the at the money. The calls are negligible. So this skew has come in, both the wings have come in dramatically, which is interesting. So it's pretty much a pick 'em, whichever direction you want to go, to the upside or to the downside here in copper. It's not going to really cost you much or get you much to sell them in either direction out there, which is kind of interesting. Usually in the metals, we'll see a bid to the calls, or maybe if it's dropping, we'll see a bid to the puts. Not seeing that out here this week, which is kind of interesting. In terms of the action, the most active contract was also out here in March. It was the 5-quarter calls, nearly a full handle away from where we're trading right now at about 430. That's interesting, doing nearly 1,000 contracts. Of that, about 10,500 that went up this week, nearly 1,000 going up in these March 5.25 calls, which is interesting. They traded on Monday and then again today. Looks like it's actually a bit of a vertical, a 5-quarter vertical went up about 500 times on Monday. And it looks like the 5 quarters trading by themselves another 300 odd times today. So a 5-quarter vertical, interesting, a little tight. But, again, it is copper, so 1/4 point is a decent move out there. But still, interesting stuff. So 1,000 contracts combined in that one spread out here. Let's look really quickly if you see any other aberrant things lighting it up. The 470 is also pretty active in January this week. And the 5 calls, if that's not enough, also pretty active out here in February of next year. So it looks like it's mostly upside related paper here in all things copper. As we keep on rolling, we're almost out of time, listeners. Let's get to you really quickly. It is time for your futures options feedback.
It's time for your questions, comments, and insights. It's time for Futures Options Feedback. Submit your questions at twitter.com/options, facebook.com/theoptionsinsider, stocktwits.com/optionsinsider, or via questions@theoptionsinsider.com. You can also submit your feedback via our Options Insider Radio Network mobile app, available for iOS, Android, and Kindle Fire devices. You can even ask your questions live via our Mixlr chat room. So grab the Mixlr app or just search for Options Insider at Mixlr.com. That's Mixlr.com.
All right, everybody. Welcome to your feedback segment. We've got a great poll out there for you right now. You can play along. At Options is the place to go to make your voice heard. We asked you a very simple question. So let's talk about volatility this week. Specifically, which of these tradable products is the most volatile right now? Let's keep it simple. Let's go straight. Let's say front month, maybe 30-day at the money kind of volatility in these names. Gave you 4 choices. Tesla, a name that is synonymous with volatility these days. Bitcoin, also synonymous with volatility these days. Natural gas rapidly becoming synonymous with volatility if it isn't already. And then the VIX, which is volatility itself. So intriguing stuff. Dan, if you have a vote in our poll, have at it. And more importantly, sir, what do you think our audience is voting for?
Well, those are good ones that you're picking there. And if we think about how the market's been behaving, Bitcoin is, you're picking good ones in terms of volatility. I think I'll go with Bitcoin. And maybe the popular opinion may be Tesla, because they have been bouncing around a bit.
You put Tesla in any poll, and people are going to pick it, Dan.
Yeah, it seems that way.
They seem to be doing that here as well. Actually, even though Nat Gas taking it by a small margin, which is interesting. 31.8% of you saying Nat Gas right now. Right behind it is Tesla, 30.3%, 22.7% for Bitcoin, and coming in last is VIX, 15.2%. You got about a little less than a day left. Get out there. If you're listening after the fact, listeners, get on over to @options. It should be pinned there for you for the next day or so you can go there, make your voice heard out there. This is a fun one. It kind of crosses a lot of different product lines and complexes. What do you think is the most volatile? Obviously, I can't weigh in yet with the answer. We'll have to wait until tomorrow. All right, everybody. That music means we've squeezed as much living into an hour as we possibly can. This show could be 5 hours some days. There's enough going on out there. But interesting stuff. Energy just obviously dominating a lot of people's tapes out there these days, and probably going to continue doing so for some time. But before we go, Mr. Dan, if folks have questions about any of these complexes, and really, how could they not? Where should they go? What should they do, sir?
Well, they could go to dangramza.com. It's a website that I have to just share ideas. We look at 22 different markets, and the intent is that if you only look at stock indices, there may be some other markets that you want to look at. So we look at stock indexes, currencies, energy, metals, interest rates, and agricultural markets. Then you also see some red and green lines, which represent buy and sell levels. For me, I'm not making trade recommendations because I don't know the qualifications of people watching the videos. But the intent was just to share my ideas of how I'm approaching these markets and hopefully give some ideas to someone who's putting together their own decisions on how they want to approach or look at some of these markets. One of the places to begin if you don't look at futures is just watch them. Get a feel for how they move. Are they as crazy as some people feel? And I think if you do feel that way, you might be surprised. But that's the intent behind it. It's a free video. All you have to do is when you get to the website, just click on free video, little basic registration information that stays right there, and you're off and ready to go. And it's done every day the market trades. That video is available, and you can go back a couple years to see what I was saying at different points in time.
There you go. Check them out. Dan Gramza, GRAMZA. .com. You know where to go. Check out our reports, of course, cmegroup.com/TWIFO or /TWIO. Both of those will get you where you want to go. You know where you want to go to learn more about all things small caps. FTSE Russell, FTSE Russell.com is the place to go. Check out their COVID Impact Center. A lot of good stuff over there. Some more stuff coming perhaps on the impact of all these meme names on the Russell 2000. I know that's a hot topic for a lot of you out there. And of course, give them a follow on the old Twitters while you're at it. @FTSE Russell is the place to go for more information on all that stuff in between episodes of this fine program. That's going to do it for us today. We'll be back again tomorrow, noon Central, 1 p.m. Eastern for Volatility Views, breaking down all the world of equity volatility you can handle in a 1-hour show. Then back again after that, 2 p.m. Central, 3 p.m. Eastern for Options Oddities. All the way through, actually, I should remind you, no TWIFO next week. Thursday, of course, the Thanksgiving Day holiday here in the U.S. So everybody have a safe and healthy holiday. We'll see you back here in 2 weeks. Another episode of TWIFO.
This Week in Futures Options is brought to you by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world manage risks and seize opportunities. CME Group offers the deepest and most liquid options on futures across all asset classes, including interest rates, equity indexes, foreign exchange, energy, agriculture, and metals. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. This Week in Futures Options is also brought to you by FTSE Russell, a leading global provider of benchmarks, analytics, and data solutions. Investors in the U.S. and around the world are using FTSE Russell indexes to benchmark their investment performance and create investment funds, ETFs, structured products, and index-based derivatives. Many Options Insider Radio Network listeners will be familiar with the Russell 2000 Index. Russell 2000 futures and options are currently trading on the Chicago Board Options Exchange and CME Group. For more information, please visit ftserussell.com, cboe.com, and cmegroup.com. This broadcast is intended for informational and educational purposes only and does not constitute trading advice or the solicitation of purchases or sale of any futures or options. The rulebook of the applicable exchange should be consulted as the authoritative source on all current contract specifications. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.